Accounts receivable represent formal claims owed to an entity by its customers. These assets are generated directly from credit sales. Under the accrual accounting method, revenue is recognized immediately upon sale, regardless of when cash arrives. Statistical reality dictates that a portion of these customers will inevitably default on their payments. Accountants cannot wait for an actual default to record a loss. To comply with the matching principle, the estimated cost of granting credit must be recognized as an expense in the exact same accounting period that the related revenue is recorded. To absorb this estimated loss, we use the allowance for credit losses. This contra-asset account directly offsets gross receivables on the balance sheet. Subtracting it yields the net realizable value, reflecting only the cash the entity realistically expects to collect. GAAP strictly requires this allowance method, but it permits two distinct mathematical approaches to calculate it. Mastering these pathways allows financial professionals to deconstruct financial statements and reverse engineer missing cash flow data. The structural difference between the two approaches lies in their objective. One calculates the journey of the expense, while the other dictates the destination of the ending balance. The income statement approach, or percentage of sales method, focuses entirely on the journey. It directly calculates the current period's credit loss expense based strictly on the volume of new credit sales. Looking at the Nidberg Company data in this example, management expects credit losses to average 2% of credit sales. With $500,000 in credit sales, the estimated credit loss expense is exactly $10,000. Under this method, that $10,000 expense is simply added to whatever balance already exists in the allowance account. The final $12,000 ending balance is a mathematical byproduct of the initial expense calculation. The balance sheet approach, or percentage of receivables method, reverses this logic. It targets the ending allowance balance directly, calculating it as a percentage of the total outstanding accounts receivable. This calculation applies a 6% uncollectibility rate to a $100,000 accounts receivable balance. This mandates a $6,000 ending allowance. Because the allowance currently holds an unadjusted balance of $2,000, the credit loss expense must act as a plug figure. We force a $4,000 expense to adjust the account to its required $6,000 state. The income statement approach ignores the existing allowance balance when calculating the expense, whereas the balance sheet approach is entirely dependent on that existing balance to derive the current period's expense. Applying a single blanket uncollectibility rate to an entire receivables balance is inherently inaccurate. The risk of default increases every day an invoice remains unpaid. To refine this estimation, entities prepare an aging schedule. This stratifies the receivables by age, aligning the probability of default with chronological risk. This aging schedule illustrates the progression. The estimated uncollectible rate rises significantly over time, starting at 2% for new debts and climbing to 20% for debts older than 90 days. By applying these specific percentages to their respective strata, management determines a highly precise required ending allowance balance, yielding $5,280. Estimations structure the balance sheet, but we must also account for actualities. Eventually, a specific customer's account will be officially deemed uncollectible and written off. The mechanical accounting entry for a write-off removes the specific claim. It reduces both the gross accounts receivable and the allowance for credit losses by the exact same amount. Because both the gross asset and the contra asset decrease equally, a formal write-off has zero impact on the net realizable value. Furthermore, the write-off has no effect on current expenses, as that cost was already recognized during the initial estimation phase. Financial professionals and internal auditors rarely receive perfect information. They frequently must derive operational truths from incomplete financial snapshots. This problem set provides specific facts for a single period. We have the beginning gross receivables, the beginning allowance, credit sales, bad debt expense, and total accounts written off. The central mystery is stated at the bottom. Based on these disparate accounting entries, calculate the exact amount of cash collected from customers during this period. To solve this, we rely on the core reconciliation equation that governs all accounts. Beginning balance plus additions minus subtractions equals the ending balance. This is commonly referred to as the base roll. Because the receivables life cycle operates as a closed mathematical system, applying this equation allows us to work backward and expose any missing variable. We begin the reconstruction by calculating the ending net accounts receivable. Adding the $30,000 stated increase to the $4,500 beginning net balance gives us an ending net balance of $34,500. Next, we reconstruct the specific allowance account over the period. Taking the $500 beginning balance, adding the $2,000 recognized expense, and deducting the $1,000 in write-offs yields an ending allowance of $1,500. By adding this derived ending allowance back to our ending net accounts receivable, we expose the true ending gross accounts receivable, $36,000. We can now establish the master base roll for gross accounts receivable. We insert all verified components, $5,000 in beginning gross, plus $100,000 in credit sales, and minus $1,000 in write-offs. Subtracting our newly found $36,000 ending gross reveals that the only remaining mathematically possible subtraction is the cash collected. The calculation leaves us with exactly $68,000. The receivables life cycle operates as a mathematically verifiable ecosystem, governed by the matching principle and proven through the precision of strict